John Griswold here with Griswold Group. Welcome to the latest installment of what the heck is going on in San Diego in real estate land. It's been an interesting development. I mean, we all saw interest rates drop precipitously leading up to the Fed meeting. They were over 6.5%, and they bottomed at, I believe, like almost 6.15, 6.15, around that, in the teens there. And then the Fed met, and then rates jumped up. Not a lot, but they did jump up. A little disappointing for a lot of home buyers out there who thought maybe they'd stay where they were or keep dropping. And that is reflective of what the stock market and the bond market does versus what the Fed does. And oftentimes, it's all baked in, and then if the Fed is more conservative or sort of like a little in line with what they thought, the rates will actually go back up. So for example, they dropped it 25 basis points on the federal funds rate. If they dropped it 50, we might have seen a different reaction from interest rates the next day, but because they only dropped it 25, a little lackluster response, a little hedging back the other way with the bond market. So it's been an interesting correlation between, I'm starting to wonder if, for those trying to time this, which is frankly not the best idea, but if you're trying to time interest rates, you're almost better off trying to lock something in right before the Fed meets, because the market is anticipating some positive changes versus waiting until after. Seems like that's been the case for the last several Fed meetings where the rates actually had gone up following it. So we'll have to see on the next Fed meeting in several weeks if that continues. But in terms of what's going on with San Diego, we're at about 6,000 homes on the market, which is actually a very healthy amount of inventory. The unhealthy portion of this continues to be demand, which is purely interest rate driven. Last year, we had rates below 6.5% for about 47 days before they went back up. I'm hopeful that this time around we will have rates that are lower than 6.5, which is where they are right now, for longer than that, get to the 60 to 75 day or more. The longer we stay below 6.5%, the more that the housing market is going to thaw. We're going to start to see average expected market time coming down, especially if we can hold the line where we are. And then as we're entering into the spring, we should be entering into a much more, much faster market than what we're experiencing right now, as buyers adjust to more affordability relative to where it's been. So that's something that we're tracking right now, and are hopeful that that's going to continue into the future. We're all seeing that there seems to be some softness in the economy. That softness does allow for interest rates to remain lower for duration. And so, we've got a big jobs report coming out in a couple of days. That's going to be very interesting to see what that comes out. If that comes out a little tepid or under expectations, we'll see rates come down, baking in a future federal funds rate cut, and we could see rates dropping down closer to 6% to where they are right now, which is about 6.3, 6.4. So that's kind of what we're expecting. Regarding luxury, there's an interesting data point that I'm noticing that if you look at 2 to 4 million, which some people say is luxury, some people say it isn't, and that luxury starts kind of at 4, but 2 to 4 is still a pretty strong market. It really changes at 4 to 6 million. So last year, both the 2 to 4 million range and the 4 to 6 million range were almost identical in terms of expected market time, about 130 days, so about 3 months. Now, 2 to 4 is still around that number, but 4 to 6 has more than doubled in terms of the time it's taking to sell a home in that price range. So an additional 3 to 4 months on top of what it was last year. So that's an interesting little data point to watch. A lot of that is what's going on in the stock market and the interest rates. Things are looking like it's going to improve over the next 6 months for that segment, but that's just an interesting data point that I noticed as I was looking at everything. So Hope this is helpful, and I'll talk to you on the next one.